Every single night, while most of us are fast asleep, something extraordinary happens in the world of finance. Over $2 trillion quietly vanishes from the financial system. But don't worry, this isn't a story of theft or loss. Instead, this money is simply parked somewhere safe out of reach, and most people have no idea where it goes or why. This nightly ritual is one of the least discussed yet most important mechanisms in modern finance. Today, we're pulling back the curtain on this hidden world to understand what's really happening when trillions disappear after dark. Answer lies in something called the reverse repo market. It's a strange and rarely discussed part of the financial system's plumbing. In simple terms, the reverse repo market is where financial institutions temporarily park their excess cash. But unlike a regular savings account, this is a highly technical process involving the Federal Reserve and massive sums of money. The reverse repo market is designed to keep the financial system running smoothly, but its sheer scale and complexity make it one of the most fascinating corners of modern finance. Banks, money market funds, and other big financial players are currently sitting on mountains of cash, so much in fact that it's become a problem. In finance, cash can't just sit idle, it needs to be put to work. But with so much liquidity flooding the system from years of stimulus and money printing, there simply aren't enough safe places to put it. That's where the Federal Reserve steps in, offering a temporary home for all this excess cash through the reverse repo facility. Here's how the process unfolds each night. Financial institutions lend their extra cash to the Federal Reserve. In exchange, they receive Treasury securities as collateral. The next morning, the transaction reverses. The cash returns to the institutions and the securities go back to the Fed. This cycle repeats every single night, creating a massive invisible flow of money in and out of the system. It may sound technical and even a bit dull, but the sheer scale of these transactions is staggering. At its peak in 2023, the reverse repo facility held over $2.5 trillion every single night. To put that in perspective, that's more than the entire GDP of Canada locked up and out of circulation overnight. This isn't just a technical detail, it's a massive force shaping the entire financial landscape. The fact that so much money is being parked at the Fed night after night is both astonishing and a little unsettling. Why are institutions choosing to park trillions at the Federal Reserve? The answer is simple: they have nowhere else to put it. Years of aggressive monetary policy have flooded the system with liquidity, leaving few safe and profitable options. Even though the interest rate at the Fed's reverse repo facility is low, it's still the best choice compared to the risks elsewhere. In essence, the safest move for trillions of dollars is to remove it from the economy entirely, at least overnight. Here where things get uncomfortable. This isn't a sign of a healthy financial system. In fact, it's the opposite. When the best use of capital is to take it out of circulation, it signals a lack of trust and confidence. The reverse repo facility was originally designed as a short-term emergency tool, a way to manage liquidity during times of crisis. But now it's become a permanent fixture running at record levels for years. That's a warning sign that something deeper is broke. Recently, as the Federal Reserve has raised interest rates and started draining liquidity from the system, the reverse repo balance is finally starting to fall. Trillions of dollars are slowly re-entering the economy, searching for new opportunities and higher yields. On the surface, this might sound like good news, a sign that the financial system is normalizing. But when so much cash comes back into play all at once, it can create new risks and uncertainty. All that cash that was safely parked is now on the hunt for returns. When trillions of dollars start searching for yield at the same time, markets can become unpredictable. Asset prices inflate, risks get mispriced, and bubbles can form. The reverse repo market has acted as a shock absorber for years, but now that it's deflating, the financial system faces a new set of challenges. The real question isn't where the trillions go each night, it's what happens when they stop disappearing. The answer could reshape the future of finance.